So the unrealized profit on inventory, this one is computed by taking the unsold goods, and then we multiply that with the gross profit margin. In most of the examination questions, the examiner will not have given you the margin, but the examiner will have given you something called the gross profit markup. So if you're given the gross profit markup, what you do, you use that gross profit markup to determine the gross profit margin, simply because there is a relationship between these two ratios. If you're given the gross profit markup as A all over B, then your gross profit margin here is all over B, and then to the denominator we add what? Numerator. So meaning that if, for example, you're told the gross profit markup is maybe 2 all over 7, it means that your gross profit margin will be 2 all over 7, and then to the 7 we add the numerator, so this will be 2 all over 9. So in most of the examination questions, the examiner will not have given you the gross profit margin which you appraise here, but you are given the gross profit markup. So therefore, that's how we compute the unrealized profit. So you take the goods not yet sold by the buying company, multiply that with a gross profit margin. So then which items are adjusted with this unrealized profit on inventory? This unrealized profit, number one, we raise it from the group inventory. What we mean by the group inventory, this is the inventory of the parent plus the inventory of the subsidiary added together, and then we less any unrealized profit. Next, we also deduct, or basically we also adjust this unrealized profit in the retained earnings of the selling company. So if the selling company was a parent, let's start from the retained earnings of the parent company. If the selling company was a subsidiary, let's start from the retained earnings of of the subsidiary. So therefore, we have said unrealized profit on inventory, it arises whereby there was intra-group trading, there was sales between the group members, but it happens that some of the goods which were sold by one of the group member to the other were not yet sold as at the end of the year. So what you need to do, you determine the unrealized profit by taking the unsold goods times the gross profit margin. But equally, we have said in most of the cases, the examiner will not give you that particular gross profit margin. You'll be given gross profit markup. You use that in terms of getting the gross profit margin, and then once you compute the ULP, less it from the group inventory and also deduct it from the retained earnings of the selling company. Then we have the other consolidation adjustment number 4, and that is what you refer as intercompany sale of asset. Intercompany sale of asset. So when talk about intercompany sale of asset, this is where we have a group member selling to the other group member an item of asset. For example, in this case, you can be told that the parent company here, sold an item of PP, an item of property, plant and equipment to the subsidiary company. So as far as this transaction is concerned, there are two adjustments which are made here. The first adjustment is adjustment in relation to an realized profit on the sale, and the other adjustment which we make as far as this is concerned is adjustment relating to depreciation overcharge by the buying company. So in this case, I'm only talking of unrealized profit and also depreciation overcharge. But it is important to note that whenever an item of asset has been sold by one of the group member to the other, it can be sold at a profit or at a loss. at a profit or at a loss. So if it was sold at a profit, the profit which was reported by the selling company, this entire profit will not yet be realized, because we know that, for example, once the parent company sell an asset to the subsidiary, is the subsidiary supposed to sell that asset to third parties? No. The subsidiary company should not sell, or is not buying that particular asset to sell it to third parties. So it is buying that asset to use it. So therefore, the profit which was reported by the selling company, the entire profit will not yet be realized. But equally, the asset can be sold at a loss, which is not a common scenario. So all the questions which have come across is whereby you are told the asset was sold at a profit, which you are saying that profit, the entire amount will not yet be realized. And then as a result of that, you have to compute now the depreciation overcharge by the buying company. So let's look on which items are adjusted with these two items. So the first one is unrealized profit on the sale. The unrealized profit on the sale is basically the profit which was reported by the selling company. So if this company sold an item of PP and it reported a profit of 50 million, we are saying the entire profit will not yet be realized. So which items are adjusted with this unrealized profit? One, we adjust this in the group PP, in the group property, plant and equipment. Remember, group property, plant and equipment, this is a PP, the property, plant and equipment of the parent plus that of the subsidiary, and then to this we less the unrealized profit, because now this company will have accounted for that item in its books of account. The item it bought at a selling price. So therefore, its PP will be overstated with the profit reported by this company. So deduct the unrealized profit from the group PP, and then deduct that unrealized profit from the retained earnings of selling company. Retained earnings of the selling company, also deduct it there. Other than deducting it from the group PP, deduct it from the retained earnings of the selling company. That is the adjustment which is made as far as the unrealized profit is concerned. So the other adjustment which will be made is the depreciation, or is the adjustment in relation to depreciation overcharge. So why do we compute depreciation overcharge? We are saying the PP of the buying company, of the purchasing company, will be overstated with the element of the profit, with the element of what? Of the profit. So therefore, what we do is basically to compute that depreciation undercharge, and when computing depreciation undercharge, you compute it based on the revaluation, not the revaluation gain, sorry. You compute it based on the unrealized profit. So the examiner may, or you may be told that this company may be depreciate its asset at a certain rate. So what you do to compute the depreciation undercharge, you take the rate which is given to you, multiply that with the component of unrealized profit. Alternatively, the examiner may have given you something called the estimated remaining useful life of the asset which was sold. To compute the depreciation undercharge, or overcharge, that is, you take the unrealized profit, divide that with what? With the remaining useful life of that asset. And then you'll get a figure here. So this figure of depreciation overcharge, one, you adjust it in the group PP. You add the PP of the parent, that of the subsidiary, and then to this you are going to add the depreciation overcharge. This company had overcharged the depreciation. It reported a PP which were, or the net book value of the PP was understated, and then that depreciation overcharge, you also added to the retained earnings of the buying company. This company overcharged depreciation during the current year. As a result of that, its profit, or its reported profit, was understated. So that is the adjustment we make as far as depreciation overcharge is concerned. We are saying compute that depreciation overcharge by taking the unrealized profit times the rate which is provided. If you are not given the rate, you'll be given the remaining useful life of that asset. Divide the unrealized profit with the remaining useful life, deduct that or add that to the group PP, add it to the group retained earnings of the buying company. So therefore, as far as the preparation of consolidated statement of financial position is concerned, we have those key consolidation adjustment which you should be in a position to deal with. And basically what I've said is that anytime you come across a question for from this topic of group account, at least you'll come across 3 adjustments. The common one is fair value adjustment. The other one is adjustment in relation to unrealized profit, and the other one is in relation to amount of intercompany debt. So this one is not that very common, though it is tested from time to time. So therefore, those consolidation adjustment are key. You must be in a position to deal with them if you want to be comfortable, or basically if you want to handle any question from this topic comfortably. So next, I want us to look on how we prepare the consolidated statement of profit or loss. Consolidated statement of profit or loss, which is basically the same with the consolidated income statement. So how should you prepare this? If you are told the parent company here has acquired a subsidiary, and you are required to prepare now the consolidated statement of profit or loss. So how do you go about in preparing this? So let's look on the consolidation procedures, the procedures you follow, the steps you follow for you to successfully prepare what is required. Consolidation procedures. Number 1 is that you add similar items of revenue and expenses. Similar items of revenue and expenses, those of the parent and those of the subsidiary. You add similar items of revenue and expenses, those of the parent and those of the subsidiary. So we can say number 1, add similar items of revenue and expenses, those of parent company and subsidiary company. And in this case, it's also important for me to mention that you may be told that the parent company, for example, acquired 80% of the shares in the subsidiary, 80% of the ordinary shares of the subsidiary. Now, in this case, when preparing the consolidated statement of profit or loss, we are saying you do what? For example, for revenue, and also expenses, here, we are saying you take that of the parent, and basically you take 100%, the full amount of the revenue of the parent, and the same case with the expenses, the full amount of the expenses of the parent, and you add 100% of the revenue and expenses of the subsidiary, even if the parent company didn't acquire 100% shareholding. In the past, I've seen most of the students making a mistake whereby when taking the revenue and expenses of the subsidiary, they multiply that, or they take 80%. That is very wrong. You take 100% of the revenue and expenses of the subsidiary, even if the parent company didn't acquire a 100% shareholding in in the subsidiary. Number 2, we say that for subsidiary acquired in course of the year, take into account its results from date of acquisition. It results from date of acquisition, i.e. time apportioned. So basically what that means is that if, for instance, you are told that the parent company acquired the subsidiary maybe 6 months to the end of the financial year, or basically to the date of consolidation, then you are saying when taking the revenue and expenses of this subsidiary, then you cannot take those items for the whole year, because the subsidiary was just acquired 6 months to the end of the year. So therefore, when taking the revenue and expenses of this subsidiary, you only take those items for 6 months. And therefore, what you do, you take the full amount of revenue and expenses, that of the parent, that of the parent, the full amount of revenue and expenses, that of the parent, and then you add the revenue and expenses of the subsidiary only for how many months? 6 months. So therefore, in the event a subsidiary was acquired during the current financial year, then we are saying what you do, you take into account its results only from the date of acquisition. You apportion all items of revenue and expenses, those of the subsidiary, on time basis. On time basis. Then procedure number 3, that is step number 3. Number 3, you make the necessary adjustments. Make the necessary consolidation adjustments. Consolidation adjustments. So in this case, we are going to look on or to discuss those adjustments which are made, and they involve consolidation relating to or basically you can refer to this as intra-group sales. Intra-group sales. The other one is adjustment in relation to any unrealized profit on inventory. We also have any or basically adjustment relating to depreciation, other charge or depreciation overcharge. Overcharge. And also we have adjustment in relation to what? In relation to any impairment loss on goodwill. Any impairment loss in relation to goodwill, and also any adjustment relating to intra-group investment income. Intra-group investment income. So these are various adjustments which are considered specifically in preparing the group or the consolidated statement of profit or loss. We are going to discuss them in details, and then after making those consolidation adjustment, finally what you do, you split the profit for the year. Split the profit for the year into a profit attributable to parent company, and NCI. So the profit which you are going to get after preparing now your consolidated income statement, we are saying you split it into two. You split it into two, into the profit attributable to the parent company and the profit attributable to NCI. So the first thing we do here is to compute the profit attributable to the non-controlling interest. To compute the profit attributable to NCI, what do we do? We take the percentage NCI, and then we multiply this with the subsidiary company profit after tax, plus or minus any consolidation adjustment, plus or minus any consolidation adjustment. So basically, you'll be able to understand this better when looking on an illustration question. I'll be able to explain in details some of the consolidation adjustments which we make or which are adjusted to that subsidiary company profit after tax. So therefore, these are generally now the consolidation adjustments, or not the consolidation adjustment, but rather the consolidation procedures which are followed, particularly when preparing a consolidated statement of profit or loss, or a consolidated income statement. So I want just to mention something as far as these consolidation adjustments are concerned. Consolidation adjustment. So maybe I'll start with the adjustment in relation to intragroup sales or intragroup trading. Intragroup trading. So intragroup trading is sales between the group members. The group members, for example, sales between the parent and the subsidiary, or sales by the subsidiary to the parent. So any amount of sales between the two companies, this one we always deduct it, or we always adjust it in our consolidated statement of profit or loss by deducting it from the group inventory. So it's the group revenue, not the group inventory, from the group revenue, and also we deduct this from the group cost of sales. So assuming you come across a question for group account and you're told the parent company sold some goods now to the parent, or the parent sold some goods now to the subsidiary, or the subsidiary sold some goods now to the parent. So when preparing the consolidated statement of profit or loss, what you do, such sales, you less them from the group sales. The group sales is the sales of the parent plus that of the subsidiary. You less that from the group's sales, and also you less that from the group cost of sales, which is the cost of sales of the parent plus that of the subsidiary. So the other adjustment is adjustment relating to unrealized profit. Remember, you have looked on how we determine the unrealized profit, which we said is determined by taking the unsold goods times gross profit margin. So this unrealized profit on inventory, this one is added to the group cost of sales. Is added to a group cost of what? Of sales. To the group cost of sales. So in preparing the consolidated statement of profit or loss, any unrealized profit on inventory, we add it to the group cost of sales. Then we also have the other adjustment relating to depreciation, overcharge, or other charge. Depreciation, other charge, or over a charge, specifically for the current year. For current year. So this particular depreciation, overcharge, or other charge, when preparing this consolidated income statement, if it is a depreciation other charge, that one is added to a group cost of sales. To group cost of sales, it is added to the group cost of sales, any depreciation other charge, but a depreciation overcharge, this one is deducted from the group cost of sales. From the group cost of what? Of sales. From the group cost of sales. And then from there we have the other adjustment in relation to any impairment loss. So impairment loss, this one, is the decrease in the value of goodwill. Any goodwill arising on the, or which arose on the date of acquisition, you can be told that that goodwill had reduced in value, or in other terms, an impairment review was conducted at the end of the year, and it was found that the goodwill was impaired with a certain amount of money. So that particular impairment loss, when preparing the income statement, you add it to the administrative expenses. This one is quite simple. You add it to the administrative what? Expenses, to the group administrative expenses. And then finally we have adjustment relating to intragroup investment income. When we talk about intragroup investment income, this refers to any investment income which is generated from within the group. A good example include dividends received by parent company, from subsidiary company. So dividends received by parent company from what? Subsidiary. Generally what we know is that once the parent company acquire majority of the shares in the subsidiary, the parent company is investing in a subsidiary by acquiring majority of the shares. So if this company happen to have paid some dividend during the current year, happen to have paid some dividend during the current financial year, those particular dividends or some of those dividends will be paid to the investor company, which is the parent company, and the parent company then will proceed and account for these particular dividends in its income statement as an investment income. But in this case, you can see this investment income is an investment income which is generated within the group. Remember, you said in the introduction, a group is basically the parent company and its what? Subsidiary. So therefore, this dividends received by the parent company from the subsidiary, which you're saying is an investment income from within the group, this one we say should not be included in the consolidated statement of profit or loss. So this one is excluded in consolidated statement of profit or loss. Excluded from the consolidated statement of profit or loss. Don't include it there because this is an investment income from within the group. Any investment income which we include in our consolidated statement of profit or loss is any investment income generated from outside the group or received from outside the group. So therefore, in preparing the consolidated statement of a profit or loss, those are some of the adjustments which are also important and basically which you must be in a position to deal with. So therefore, generally what we have discussed here is how the group account, how the consolidated financial statements are prepared when the parent company has invested in what? In a subsidiary. We have looked on the preparation of the consolidated statement of profit or loss, and also the preparation of the consolidated statement of financial position. And equally of importance, what you have discussed are the consolidation adjustment, those particular adjustments which are made when preparing consolidated income statement, consolidated statement of financial position. So that basically is the end of that. Once we meet in our next session, what we are going to do, we are going to look on an illustration question regarding the preparation of group account from CASNEB past papers.